Welcome to the Explainer. You know, if you're managing business finances or filing taxes, the whole GST landscape can sometimes feel like you're navigating a minefield, completely blindfolded. Well, today, we're taking off that blindfold. We're going to decode some of the most complex tax rules out there regarding input tax credit, or ITC, and turn them into actionable, crystal clear business compliance. Get ready to completely master the intricacies of ITC reversals.
Okay, let's dive right into this. Are you illegally claiming GST credits without even knowing it? I know it sounds harsh, but it is a massive, high-stakes reality for literally thousands of businesses right now. You might sit there and think your books are perfectly clean just because you hold a valid invoice. But GST compliance goes way beyond just holding onto a piece of paper. Hidden deep within the rules are these traps that can turn a perfectly legitimate credit into a severe compliance violation, basically overnight.
So, before we get into the really complex rules, let's make sure we're all on exactly the same page. What actually is an ITC reversal? Very simply, it's the statutory requirement to return or reverse a previously claimed input tax credit. You know, you claim a credit to reduce your tax liability, but due to specific business scenarios or maybe just a tiny compliance slip, the government essentially taps you on the shoulder and says, hold on a second, you need to give that credit back.
Here's our quick roadmap for today's explainer. First, understanding blocked tax credits. Second, the ticking time traps. Third, navigating mixed-use assets. Fourth, specific business scenarios. And finally, professional audit solutions. All right, part 1, understanding blocked tax credits.
Under Section 17.5 of the GST law, certain items are just flat-out blocked. If you try to claim ITC on passenger motor vehicles, food and beverages, your fancy club or fitness memberships, or goods that were lost, stolen, destroyed, or even just given away as free samples, you are in direct violation of the rules. There's really no gray area here. If you mistakenly claimed credit on any of these things, you've got to reverse it immediately. Moving on to part 2, the ticking time traps. And this brilliantly illustrates one of the absolute most common pitfalls, the 180-day rule. Under Rule 37, the clock is quite literally ticking. When you receive an invoice from a supplier, you naturally just claim the ITC, right? But if you fail to pay that supplier the full value of the invoice, including the GST, within exactly 180 days from the invoice date, well, that credit becomes invalid. You are legally required to reverse the ITC you already claimed. So what happens if you actually miss that 180-day window? Well, there is a silver lining, but it definitely comes with a catch. Rule 37 realities dictate that you can actually reclaim or reavail this ITC once you finally do make that payment to the supplier. However, be warned, interest may be applicable on the reversed amount for the entire time you held onto that credit illegitimately. It is a really costly penalty just for poor cash flow management. But wait, it's not just your own actions you have to watch out for, it's your supplier's actions too. Let's say you paid your invoice perfectly on time, but your supplier fails to file their GSTR 3B by September 30th of the following year. Because of their noncompliance, you are forced to reverse your claimed credit by November 30th. Your compliance is completely chained to theirs. Crazy, right? Okay, part 3, navigating mixed-use assets.
So, when you use inputs or services for both business and personal reasons, Rule 42 steps in to simplify things with a flat 5% carve-out. Essentially, 5% of your common credit is legally deemed to be for non-business use, and therefore, that 5% must be reversed. It really just takes the guesswork completely out of the equation.
Now, what if you're separating taxable supplies from exempt supplies? Well, Rule 42 gives us a formula to proportion this credit mathematically. I know it looks like algebra, but it's actually pretty straightforward. D1 equals E divided by F multiplied by C2. In plain English, you just take the total value of your exempt supplies, divide it by your total turnover in the state, and then multiply that fraction by your common credit. The bottom line, you cannot claim tax credits on inputs used to make tax-exempt goods. But what about the really big stuff? Massive capital investments, like heavy machinery or a huge fleet of computers? This brings us to Rule 43. For capital goods used for both taxable and exempt supplies, the government actually assigns a statutory useful life of exactly 5 years, and that translates to exactly 60 months. Because the lifespan is set to those 60 months, Rule 43 requires a step-by-step monthly reversal calculation so you maintain perfect compliance over those 5 years. Step 1. Divide the total ITC claimed on that capital good by 60 to get your total monthly ITC. Step 2. Identify the portion of that month's business that's attributable to exempt supplies. Step 3. Reverse that specific proportionate amount for the month. Do this every single month for 60 months and you stay perfectly in the clear.
Next up, Part 4. Specific Business Scenario Rules.
Under Rule 44, there are two major structural shifts in your business that require immediate attention. Whether you decide to switch your business to the composition scheme or you face an outright cancellation of your GST registration, the impact is exactly the same. Both of these scenarios structurally require you to reverse the ITC on your current inputs in stock, as well as on your capital goods. You simply cannot take those credits with you when your tax status fundamentally changes.
And here is another incredibly common trap defined in Section 16.3, often referred to as double dipping. When you buy an asset, you might be really tempted to claim depreciation on the entire value, including the GST component, under income tax laws. But if you do that, you absolutely cannot claim ITC on that same GST component. The government just won't let you get a tax benefit twice on the exact same tax expenditure. You've got to choose one or the other. Finally, Part 5, Professional GST Audit Solutions. Now, what's really interesting is that you don't have to navigate these treacherous ITC reversal waters all by yourself. As a trusted and reliable service partner, XP Audit Solutions, led by GST practitioner S. Ramkumar, operates all over Tamil Nadu. They are precisely the kind of experts who step in to manage these exact high-stress compliance issues for you. They offer comprehensive online and offline support to keep your business perfectly shielded from these reversal penalties. Their expertise covers a huge array of vital needs, navigating GST and income tax appeals, providing critical statutory support, executing 44AB tax audits, managing UDIN support, and meticulously handling annual returns like GSTR 9 and 9C. Having a partner like this ensures that formulas like Rule 42 and timelines like Rule 37A are handled proactively rather than reactively when it's too late. Which brings us to our final thought for this explainer. Are your books truly compliant, or is a reversed credit audit just waiting in the wings? We've seen today how easily valid credits can turn into total compliance nightmares due to a missed 180-day window, a supplier's failure to file, or just a simple miscalculation in mixed-use assets. I highly encourage you to review your accounting practices today or seek professional help to ensure your business is fully protected. Thank you so much for joining me for this deep dive, and keep learning.